Hey everyone, and welcome to This Explainer. I am absolutely thrilled you're here. So today, we're opening up a completely new playbook. It's wild. Nobody actually teaches this stuff in school. I mean, you sit through algebra, you memorize history dates, but what about the unwritten rules of money that literally run your life? Well, in This Explainer, we're going to change that. Think of me as your friendly financial mentor. Together, we're mapping out the core concepts to take you from that very first part-time paycheck all the way to building real, lasting wealth. Let's just dive right in. Okay, let's hook right into a feeling you might already be super familiar with. So you finally land that part-time job, right? Maybe you're working retail or slamming espresso shots at a local coffee shop. You put in the hours, you do the mental math, but then you open that very first paycheck and boom. The number staring back at you is, well, way smaller than you expected. You're just left standing there staring at the paper wondering, wait, where did half my money go? That shock is a total rite of passage. Which brings us to our first section, your first paycheck. We're going to look at two massive forces that interact with your brand new income before it even hits your wallet. First, take a look at that big number right at the top. That's your gross pay. That is the amount of money you actually earned. So if you work 20 hours at $15 an hour, your gross pay is $300. It's a nice, round, super satisfying number. But it's temporary because, well, the system always takes its cut before you get to touch it. So, that painful gap between your gross pay and the net pay you actually take home, yeah, that's taxes. The government takes this slice to fund things we all use: roads, schools, the military, public services. Now, we use a progressive tax system, meaning as you earn more later in life, the percentage you pay usually goes up too. But here's a little mentor secret for you. While taxes aren't optional, learning the rules early, like understanding legal deductions, that's what helps you keep way more of your hard-earned pie intact. Okay, so you get your net pay. What do you do with it? You probably put it in a bank, but let's completely redefine what a bank actually is. When you deposit your cash, it isn't just sitting in some giant cartoon vault gathering dust. Actually, you are lending your money to the bank. They take the cash from your part-time job and they loan it out to other people so they can buy houses or cars. And in exchange for the privilege of using your money, the bank pays you a tiny interest rate. Your money is protected by the government, sure, but make no mistake, the bank is definitely using it. And honestly, that's exactly why you see different types of accounts when you log into your banking app. You've got your checking, your savings, and money market accounts. Why so many? Well, because banks want your money parked for different lengths of time. A checking account is basically a revolving door for your daily spending, but a savings or money market account, that's meant to sit longer. So the bank will often pay you a slightly higher interest rate to keep it there while they lend it out behind the scenes. All right, let's shift the timeline forward a little bit. You've saved up some cash and you're hitting a massive high school milestone, buying your first car. This brings us to section 2, the cost of borrowing. Remember how the bank paid you a bit of interest to use your money? Well, interest is the ultimate double-edged sword. Put simply, it's just the cost of using someone else's money. When you save, it's a sweet reward. But when you borrow to buy that first car, it's a cost. And the real danger here is compound interest. Compound interest literally means you pay interest on your interest. So a small debt left unpaid, it can balloon wildly out of control, growing exponentially the longer it sits there. Think about it like this. Imagine you and a friend are buying the exact same used car for the exact same price. But because of a 3-digit number called a credit score, you get a low interest rate and your friend gets slapped with a high one. Because of that rate, your friend could end up paying thousands, sometimes tens of thousands of dollars more over the life of the loan for the exact same car. Lenders use that score to decide how risky you are. Getting approved for a loan isn't the real win. Getting a loan that doesn't bleed you dry over time, that's the win. Luckily for us, the formula for building a stellar credit score is totally in your control. Here is your step-by-step roadmap. Step 1, pay your bills on time, every single time. Payment history is absolutely huge. Step 2, keep your balances low relative to your limits. If you get a credit card, please don't max it out. And step 3, limit opening new accounts. Don't just apply for every store card that offers you a 10% discount at the register. If you stick to this formula from day one, you'll secure those cheaper approval rates for life. Okay, so now that your personal foundation is set, we need to zoom out. Because even if you do everything right, there are massive, unseen forces quietly impacting your daily spending power. Let's look at section 3, how the economy moves. You ever hear your grandparents talk about buying candy bars for a nickel? Yeah, That's inflation. Over time, prices rise because the supply of money in the economy tends to grow faster than the supply of goods. Now, a steady, healthy amount of inflation is totally normal. It encourages people to actually spend and invest. But when inflation gets too high, the money sitting in your piggy bank quietly loses its value. It is literally buying you less every single year. So stuffing cash under a mattress, as comforting as it sounds, it's actually one of the absolute worst long-term financial strategies you could possibly have. And on the flip side of inflation, we have recessions. I know, they sound incredibly scary, especially when you hear about them on the news. But economies move in normal cycles of growth and contraction. A recession officially happens when economic activity shrinks for 2 consecutive quarters. Businesses sell less, maybe companies cut jobs. Here's the thing, if you are over-leveraged with a mountain of debt, a recession is a nightmare. But if you are prepared with emergency savings, a recession is really just a storm you can comfortably ride out. Being prepared is what turns panic into stability. Let's look at the currency itself for a second. Your money isn't backed by physical gold anymore. It's backed by trust in the government. When that trust wavers, currency loses value. You might actually notice this when you try to buy something online from another country, right? Exchange rates are constantly fluctuating. That item suddenly costs more or less depending on the week. And because of all these moving parts, smart financial minds spread their money around so they aren't relying on just one currency to hold its value. All right, up to this point, we've talked a lot about defense. Protecting what you have. But you can't just save your way to true wealth. We need to play some offense. Let's transition into how to make your money actually work for you in Section 4, Making Your Money Grow. Saving protects your money, but investing, that's what beats inflation. When you invest, you're buying a small piece of something. You can buy stocks, which means you literally own a tiny piece of a company. You can buy bonds, which is essentially you loaning your money to the government. Or you can buy index funds, which let you buy a broad slice of the entire market all at once. Now, stocks swing harder, but they grow more over time. Bonds are steadier, but they grow slower. The core rule you have to remember, risk and reward are permanently linked. Higher potential growth absolutely always means taking on higher potential loss. But hey, making smart choices isn't just about picking the right stock. It's about understanding the difference between price and value. Price is what you pay today. Value is what something is actually worth to you long term. Imagine you buy a cheap $20 pair of shoes, but they fall apart in a month. So you buy another pair and another. Over a year, you spent way more than if you had just bought the high-quality $100 shoes that last a decade. This exact logic applies to everything. Taking on student debt, choosing a job, or buying a car. The upfront cost rarely tells the full story. Always hunt for value, not just the lowest price tag. So, we've covered taxes, banks, interest, inflation, and investing. But every single one of these concepts relies on one incredibly powerful variable. It is the absolute ultimate superpower you possess right now as a high school student. Let's look at Section 5, your greatest asset: time. If you plant a financial seed at age 16, thanks to that compound interest we talked about earlier, it has decades to multiply. Guys, the math is genuinely awe-inspiring. A single dollar invested right now dramatically outpaces a much larger amount of money invested by someone who waits until they're 40 or 60. The people who win financially, they aren't necessarily geniuses, and they don't have a crystal ball. They simply start early, buy a broad slice of the market, and let time do the heavy lifting. Debt left alone gets worse. Investments left alone get better. Time changes how every single financial rule works on you. And right now, you have more of it than any billionaire out there. So the only question left to ask yourself after reviewing these concepts is this. Based on the habits you start building today, with that very first paycheck, will time be your friend or your enemy? Think about that. Apply these rules and go take control of your financial future. Thanks so much for watching this explainer, and I'll see you next time.